So we talked about the Roth IRA, right? How beneficial a Roth IRA can be if it is that tax bracket should go up later, right? So remember, when you contribute to your 401k that's at work, so the 401k, 403b, 457, traditional IRA, SEP IRA, any one of those accounts which you are contributing pre-tax dollars into, you're deducting you're deducting from your income currently, which lowers the amount of taxes you're paying now. But ultimately later, when you are ready to pull that money out, you will be paying the taxes. So you're exposed to the risk that later when you're pulling that money out, you could be paying much more in taxes. What are your options? We talked a little bit about the Roth IRA, right? Of course, not everyone has the option of contributing directly to a Roth IRA depending on what your income looks like. Now, if you're making more than the amount, or you're trying to contribute more than what is allowed to go into a Roth IRA, because the maximum limit to go into a Roth is $7,000 per year, you probably would benefit from putting your money in an actual life insurance policy. So if you're looking at contributing a whole lot more than $7,000 per year with the primary purpose of using that for retirement income, a life insurance policy may be your best bet, because the same rules that apply in terms of the actual cash value into a Roth, those same rules apply to the life insurance policy. That money, right? So you have policies that are invested in the market similar to the Roth, and that money grows tax deferred, so you're not incurring any taxation as that account is growing based on market performance or otherwise. And when you're pulling the money out, once the policy is structured correctly, and ultimately you ensure that the policy is still in force, you ultimately can pull the money out tax-free. So just imagine, you put in to that life insurance contract about $100,000, like we talked about with the Roth. That money doubles to now $200,000. Not a lot of money for retirement, but just the whole concept of it is, if you're pulling that money out, you would get that money out tax-free. So regardless as to what taxes may look like in the future, using a vehicle like the Roth or the life insurance could ultimately make sure that you don't have to worry about what taxes could look like in the future when you're ready to pull that money out. Like, subscribe, and I'll see you in the next one.